In institutional trading desks like those at Goldman Sachs or Citadel, options are managed not just by looking at direction, but by analyzing their sensitivities, known as the Greeks. For example, a trader may hold a large book of S&P 500 options and monitor its delta to understand directional exposure, gamma to assess non-linearity, and Vega to gauge volatility sensitivity. These metrics help traders adjust their positions in real time to ensure the portfolio remains balanced regardless of market swings. A desk might neutralize its Vega if expecting a volatility drop or hedge delta exposure after a sudden index rally, illustrating how option pricing models are at the heart of modern derivatives trading. Options derive their value from two main components: intrinsic value, which is the immediate profit if the option were exercised now, and time value, which is the extra value based on the time left to expiry and volatility. Mathematically, the option price equals intrinsic value plus time value. Factors that affect option pricing include the price of the underlying asset, strike price, time to expiration, volatility, risk-free interest rate, and dividends for stocks. One of the most widely used models for pricing European options is the Black-Scholes model. It assumes constant volatility, no dividends, European-style exercise only at expiry, and a log-normal distribution of returns. While it has limitations, it remains foundational and introduces the core sensitivities known as the Greeks. Delta is the sensitivity to price change in the underlying asset. It measures how much the option's value changes per $1 move in the underlying. For call options, delta ranges from 0 to 1. For put options, delta ranges from 0 to -1. Gamma is the rate of change of delta. High gamma means delta can change rapidly with small price movements. Gamma is important for managing portfolios near expiry or near the money options. Theta represents time decay. It measures how much value an option loses per day and is higher for out of the money and near expiry options. Vega measures sensitivity to implied volatility. Higher Vega means more sensitivity to changes in market volatility. Options closer to the money with longer time to maturity have a higher Vega. Rho measures sensitivity to interest rate changes and is generally less important for short-dated options or low-rate environments. A trader expecting high volatility might seek high Vega positions. Theta is a concern for option buyers as positions lose value over time. Delta-neutral portfolios can help isolate volatility bets. Gamma spikes near expiry, demanding quick reaction for risk control. Here's a quick summary of the Greeks, key metrics that help manage option risk. Delta shows how much an option's price moves with the underlying. It's used for gauging directional exposure. Gamma measures how fast delta changes. It's important for managing near expiry or at the money options. Theta tracks time decay. Option buyers lose value daily while sellers benefit. Vega reflects sensitivity to volatility. Higher Vega means bigger gains or losses when implied volatility changes. Rho measures how options react to interest rate changes. It's more relevant for long-dated contracts. Together, these Greeks help traders adjust strategies, hedge risk, and stay responsive to market shifts